panel, what we decided to do is focus on one particular aspect of corporate governance, and that's exploring the challenges of exercising independent corporate governance in a period of increased passive investing. And so for those of you that have been at the conference all day, there's been a common theme across some of the panels about the increase in passive investing. And what we've got here are four distinguished panelists who represent the broad ecosystem in terms of corporate governance. First, we have Tom Clark, Managing Director and Head of America's Global Public Policy at BlackRock. And he's going to give the perspective of an asset manager that employs passive strategies in their exchange-traded funds and other investment products and services. Next, we have Bill Anderson, Senior Managing Director at Evercore and Global Head of Evercore's Activism/Raid Defense business and Strategic Shareholder Advisory practice. And so he'll give us the perspective of an advisor to public companies that interact with both active and more increasingly passive investors. And then we have Waka Samad from FTSE Russell, who's the CEO of Benchmarks, and Raman Subramanian, who's a managing director at MSCI, and they will give us the perspective of index providers that develop index construction rules that drive the inclusion of securities into indexes to meet investor demand. So what I thought I'd do is let me start out with Tom and just ask a threshold question, sort of a naive question, and say, look, you know, BlackRock obviously has a lot of ETFs, passive strategies. You follow the indices that these two folks and others put together, right? It's very rules-based, very driven. What your job is to do is to manage tracking error on these things. So why would a passive index fund manager spend any time on corporate governance?
Well, first of all, I'd like to thank you for the question. It's an excellent one, Mike, and of course thank the Georgetown and the Business School for having us here. I think it's a really timely time to have this kind of discussion around corporate governance. And your question is anything but naive. It's actually, I think, one that many people share. And you know, the answer fundamentally is looking at, you know, what is the role of asset managers as the managers, not the owners of assets, but basically as the managers who owe a fiduciary duty to the real asset owners, and what's the context for that fiduciary duty to really be executed upon. And of course, I think there is a view in the market that all you have to do is just track the index. Why would you even have it? BlackRock, we have a team of about 40 corporate stewardship professionals, a very robust team, one that's growing. And the reason for that really is precisely because in many of these cases, it's a situation where if the security is in the index, we're going to own it. And there's limited ability to walk away from it and sell it, precisely because it's in the index. And so really the only way to perform on that fiduciary duty to our clients, who are the asset owners, is engagement. And so that's why there's a need to have a robust corporate governance capability. I think the sort of a corollary to the maybe perception or misperception that's out there in the marketplace, I think is behind the question, is that there's a view that, well, okay, if you are just managing these assets, you can delegate your your duty to, say, proxy advisors and just follow them. And I think there is a misperception in the marketplace that that's a lot of what asset managers do. Oh, they all follow ISS, or they all follow Glass Lewis, and they do that. And frankly, there's some criticism from both sides of the political spectrum about what the consequences of that are. I think the reality for an asset manager who takes their fiduciary duty to their clients seriously is, no, they have to go in, engage with management, raise issues that they think go to long-term value. One of the criticisms is, are you, in doing engagement, somehow substituting some, social policy values that you might have for those of the asset owners? And that's where I think, the answer has to come back very clearly that no, this is about preserving and adhering to a strategy for maximizing the long-term economic value to that owners. Does that involve, looking at certain factors, commonly, ESG and other things, being satisfied that management has a strategy to how to engage on that? Yes. And it's making sure that there is that level of engagement. I mean, the other key thing, I think, to answer your question, Mike, is, it's a very good question, and to answer any question that's complex, there really needs to be data. It has to be a data-driven response. And I think when you actually peel down below, let's say, the aggregate data that says, oh, asset managers, vote 97% of the time with management, and there's a perception that they're all either following the proxy advisors or just following management, it kind of like builds that thesis. But actually, when you disaggregate the data and you start to look at, the underlying strata of, well, what if we break it apart between, say, management proposals that are being voted on and shareholder proposals that are being voted on, where, there's, almost unanimous agreement, not unanimous, but I mean, like, 98, 99% agreement with what you might call routine management proposals, things like election of director, re-election of, or reappointment of statutory auditors, things like that are very common. That's almost like a background noise. It overwhelms the more, interesting sort of substratum of data. Because, well, let's focus on some of the controversial shareholder proposals. There you'll find that, that ISS recommendations in favor of those shareholders are at around 70%, whereas, the votes of asset managers, well, frankly, even they within themselves are all over the place. They're certainly well below 70%. You have Vanguard, my firm BlackRock, you have Fidelity that are somewhere in the teens. You have State Street and Capital Group that are, up around 32, 33. So, we're clearly not just following the proxy advisors. We're not even following each other. And even if you were to say, oh, Vanguard and, BlackRock both have around 16%, if you drill down and look at which proposals constitute the 16%, they'd be different. So I think the takeaway is that there's a lot of difference, and that really comes from, a case-by-case evaluation of the proposals, what's in, the best interest of the clients who are ultimately the asset owners. And I think once we do that, hopefully we begin to see the case for why, even when you're a passive, fund, that's not an excuse, that's not a reason to abdicate, engagement, but you still have that obligation to look out for the interest of the shareholders.
Yeah, thanks. So Bill, from an issuer's perspective, right? So your title is, head of Evercore's activism/raid defense, right? So a lot of your job has been dealing with active investors, and the most active, the activists. Mm-hmm. Now you have an engaged passive investor community. Do we call them pacifists? I don't know. We can put a hashtag on it, right? Are there any particular challenges or opportunities with engaging with a new set of investors that maybe have a different perspective than the traditional sort of active investors that the companies you advise have been dealing with?
Yeah, I've been looking at this for a long time. I've been in the shareholder focus. I was an M&A partner at Goldman Sachs for a long time, last couple of years at Evercore. One of the signature situations I'd worked on is a company called Target, the retailer. Bill Ackman ran for a fight. And we went out to sue the index funds, and we called them, I think we got Siri, because there was no one there. There really was no one at the index funds at the time. They filed at ISS, and ISS was very supportive of Mr. Ackman. But the point was that the index funds did not have an engagement program. That's changed dramatically. I think companies, some of them having 30, 40% of their base is index funds. And so we're advising companies, you've got to change your investor relations function to match that reality. Right now, there are about half the number of public companies that there were 20 years ago. It's pretty sad. We went out and we did a session on the West Coast. We had the chairman of Microsoft, the CEO, former CEO of eBay, talking about these tech and executives and about the world. And one of the participants said, every tech company that didn't have dual class has been hit. Apple, Microsoft, Qualcomm, Juniper, they went down the list. How can going public be part of a long-term priority? So you've got the views of that. And I think the index funds with their long-term views are a powerful counterbalance. You've got the active funds under tremendous pressure because they've lost about $1 trillion of assets to the index funds. And so they're very focused, and some of them have investments in the activists. So there's a very complex thing going on around that. But when companies say, hey, I know my investors, we say, okay, let's go through your top three. BlackRock, Northern Trust, Vanguard. Oh, but they don't show up for your earnings calls. They're not at any of the conferences. When you say you know your shareholders, you don't know 30% of them. So there's a whole dialogue, and we see there's a gentleman who, when we were defending Qualcomm against Broadcom and dealing with helping Comcast buy Sky, BlackRock had a big position in both of them, and they had a person who was a former banker who was helping them evaluate their position in their stewardship group. So because they have such big positions, they're making M&A determinations because they are decision makers in this, and it's not following ISS, at least in our experience. A lot of folks follow ISS in compensation maybe, or to pick the auditor, but on money decisions like M&A or proxy fights, we see very active engagement from the index funds. What is the difference? How do you do it differently? Well, look, I think it'd hearten most companies to say it's a discussion about long-term, about strategy, about does the board meet the strategy, it's about risk assessment, it's about diversity, it's about ESG issues, and it's not about what happened last quarter. And so that's a good conversation to have every once in a while, but it's also figuring out ways because a BlackRock will own 7,000 companies. When a portfolio manager at a T. Rowe may only own 50, to follow all those companies, even with 40 or 70, will be very tough. To make sure you can communicate outside of the deal context is complicated. It's evolving. Companies are doing better with it. They still have work to do.
Now, you said one of the things you don't have to worry about is sort of last quarter. One of the things that's come up in one of the earlier panels is a potential short-term focus of U.S. investors. Do you find that the passive investors tend to be in more long-term focus, and the fact that money is shifting that direction, is that helping?
Yeah, it is. It is definitely, it's hard to generalize. Like there's passives that are different than other passives and actives the same, but generally, they tend to be longer. It's really disappointing. I mean, we have the leading advisory practice for companies on shareholder issues and in a lot of boardrooms every day. And I hear conversations like, should we invest in this plant because it will hurt our ROIC and then we're going to have a proxy fight from an activist? I'm like, invest in the plant, we'll figure out how to communicate it. But every company has been told, think like an activist. Like, does that lever up? I mean, what does that mean exactly? I think the point is that there is a heightened focus on making sure you can hit the numbers that companies are now imposing on themselves, absent the activist or the actives or whatever. So I think it's good the index funds are voicing that long-term perspective. The one problem, and it's getting better, it's hard to have that dialogue on a continuous basis, right? So that if you were talking to an active manage, and every quarter you're talking to them and in a constant loop and work, the index funds, it's tough for them to take monthly calls for 7,000 companies. It's getting better. It was, years ago, it was really non-existent. But now, I mean, it's a genuine effort. It's an area of flux right now.
Yeah, so he brings up that's a challenge. So Tom, how do you handle it? I mean, so if activist investors focus on one or two companies, they can take those calls, and you have thousands of companies.
Well, I heard earlier someone talk about, like data technologies being a great field for people. I guess corporate stewardship is going to be a great field for, people. It's something where, clearly there's going to need to be beefing up. Clearly there's going to be more capability. I do also think that as these standards come out, transparency is very important. I mean, we put up on our website, a lot of the principles that we follow. I think, as you know, our chairman has had a letter out about that. There's been a lot of discussion about it. Of course, there needs to be that individualized engagement, but I think the more that there's a, dissemination, transparently of, what it is that we're looking for, and, assuming that others do the same, there will be some sort of convergence around the mean, I think, on some of that, at least as a matter of what expectations are. But definitely there needs to be, that ongoing individualized engagement. It's going to mean more resources.
I mean, it's a different, it's funny, more transparency. I look at these proxy statements, and I think you'll need a lot of stewards to read these 200-page tomes. More disclosure. Improving it or making it more efficient, I'm a big fan of. There's very little disclosure on the shareholder side. They don't disclose where their shorts are coming from, derivative positions, So it's a little bit asymmetric on the disclosure, at least from the corporate perspective. Maybe not from a BlackRock, I think more broadly.
All right, let me move to a subject that the bill that you brought up, that had been brought up in some earlier sessions on dual class shares. I'll start off with you and then get our index providers involved in this discussion. So it was first brought up this morning when Rena brought it up with in the fireside chat with SEC Chairman Clayton, and then Stacey Cunningham and Tom Whitman in the discussion there about dual class shares and the challenges. So from a company's perspective, why do companies find dual class shares useful? And then I'll move to the index providers to give me your perspective in terms of whether deciding whether to include or exclude dual class shares in a particular index, and sort of who you're hearing pressures from, and then maybe get Tom's perspective on that too.
So the impact of dual class shares, when most of the dual class companies, 15 years ago were newspapers, the returns of them were terrible. Now every dual class company is great because it's been Google and some of Facebook and others. So the data on economics, on whether it's valuable or not, or if it creates value, it seems almost sector specific. So here's what we hear from some companies wanting to go public, because you can't put in dual class until after you're public. It's a pre-public call. If I go public at 10, if I take a nick of even $1 on my IPO price, short-term nick because of the dual class, I at least have control if Greek debt sends my stock price down to 4 or something comes in. And so the view is, when you make it, are you leaving money on the table at the beginning? And the view is, look, I'd rather have long-term control over my destiny, and I'll take the immediate hit of the dual class. And even, some venture players are okay with that. But that's the calculus they're going through, is that the market factors aren't valuing companies because of, because the index funds have sopped up a lot of liquidity. So the remaining trades are the marginal trades and can hit their stock disproportionately. So there's a view on that. But on the other hand, there's concerns, sunsets become, as far as become more prevalent. And there's concerns about accountability, because there have been a few dual class companies that haven't, had that level of accountability. It's a robust debate. But I think some companies may decide not to go public without it. So if you sort of say we can't have it, they may decide not to go public, which isn't great. So look, it's a complicated issue, and I understand where if I'm a shareholder, I'm owning shares of the stock, I'd like to be able to have more of a voice on this. And again, it's a very, very loud debate right now.
Yeah, and it seems like it's increasing. You pointed out, newspapers were one. It's not lost on me that the New York Times rarely writes about dual class shares because they have dual class shares. But it seems like tech firms, like you say, are finding this to be useful. For a long time, it was differential voting rights, and we saw the extreme was in the case of Snap with zero. Is that a trend? Was that a one-off, or do you think this is?
Look, at some level, I think some shareholders are saying without sunsets, without certain things, they may not invest. I haven't seen, there was one company that went public that the term was weapons of mass entrenchment. I think you got to make a determination of where you go public. Now, a lot of companies aren't going to go public with dual class because when they formed, they don't have the dual class set up as a private company, or the venture firms may not want it. So there's a lot of debate about it. It's not every company that has that decision point.
Okay. So let me ask the index providers. So Waqas and Rahman. So I know there's some pressures for you all whether to include or exclude dual class shares. Can you talk a little bit about the challenges around that?
So I think the issues around long-term sustainability are certainly being reflected to us by our stakeholders, who are the end users of the indices, who are pretty much every type of investor that's out there: buy side, asset owners, asset managers, active, passive, large, small, and domestic in the U.S. and international. And when we build the benchmarks, when we consider how to design those, we're really thinking about the end users' requirements to manage the performance of their funds. And very much the case that in this dual class share structure issue, we're hearing from the end investors that, first of all, it's an issue that they want us to consider from an inclusion criterion perspective in the indices, the broad market cap-weighted indices. And secondly, the way that they think about it is really about whether this represents their investable choice set in the broad market that they are, in the broad markets that they're acting in. So, we just tend to reflect not only the representative market performance, but also reflect the users of the indices requirements in building those benchmarks for performance management. We don't have an axe either way. We don't have a particular policy agenda in the dual share class structure issue, or indeed in any other issues that affect the way that we construct the indices. We really just need to try to make the tools available to the end investors, and we're guided by them as to how to do that. So, that's the context in which we took a look at this last year. We went through our usual very, very inclusive consultation process. We have pretty rigorous governance standards if we're going to consider making any changes to those broadly followed indices. And that involves not just internal governance, but also external advisory committees and broad market consultations. And the pretty clear mandate that came back to us from the consultation that we ran on that issue was that people were in favor of taking some action to deal with the dual share class structure issue in the index inclusion. So we made the step to last year to exclude companies where they don't have at least 5% of the free float with voting rights. And for any existing companies in the index, there's like a 5-year grace period. So until 2022, they'll remain in there. When we make those kind of changes, we really need to consider the potential impact for users of the index already. So we try to take a pretty measured approach in terms of implementation.
And you said in terms of governance, you have internal and external advisory committees. So who sits on those external advisory? Is it just the users, or is there others?
It's really a broad swathe of the market participants out there. So we have buy-side participants, asset owners, asset managers, some insurance companies, custodians. We have a range of external advisory committees, which are both regional as well as global. And they consider matters which are to do with index methodology or to do with country classification issues. And they tend to be very experienced individuals from those kind of companies who have been in the business for a long time and have a lot of experience in handling those matters.
Raman?
So maybe for the benefit of the audience, let's give them what's the issue. The issue is that if you look at benchmarks or indexes 40, 50 years ago, it's a bunch of basket of stocks providing a market sentiment. So nobody cared about how they were constructed. People looked at them in the newspapers and slept on that. But the last 20 years, these benchmarks have become a way to capture the market performance using index funds and ETFs. And if you are a passive investor who's tracking these benchmarks and trying to capture their performance, so it's investability, the size, liquidity is a primary criteria for you. So if I create an index and I give it to BlackRock, the first thing they're going to say is that is it investable? The companies which are included, are they sizable? They have enough liquidity to buy and hold. Now, in the last few years, we have seen that as these companies with multiple voting rights have come in, and as Bill pointed out, the case was media, because media companies wanted to have the editorial integrity. That's why they were the only one who were issuing these dual class shares, but in the recent time, we have seen technology company coming in. So the first thing which, if you are a pension plan and you are a passive investor, you're saying, if I'm going to hold these companies and if I don't get the equal right like an insider who's holding the shares, I don't have a voice. It's like if you're a citizen of a country, you probably have to vote and you will get the voting rights. And if you're born here, you stay here, you can't leave. But if you are an active guy, you can sell and move on. A passive guy who's buying the company has to buy and hold because the index provider include them in the benchmark. So that's the issue. So similar to what Mukesh talked about, we also did a broad consultation for 18 months. We went to the market, we consulted. It was a very polarizing question. Many of the investors were either on one side or the other side of the aisle, not like the Democrats and Republicans. But this was one of the things which came up was, okay, if you are an index provider, it's not your job. It's the other stakeholders. It's like the regulators, the stock exchanges, the asset owners, the asset managers. It's their job to do it. The other side of the aisle was basically the asset owners and some of the asset managers says that basically it's a passive indexer. If my role is to track your benchmark, you better reflect the choices that I'm proposing to you. So we took a decision based upon all the feedback saying that, okay, we are not going to change the whole gamut of construction of a benchmark, which is investable benchmark. Because investability is not linked to voting rights. It's not linked to economic rights. Investability is still the availability of shares in terms of free float, in terms of liquidity, whether they're a sizable company. But if you have choices and constraint in your investment process or investment choice, we'll provide you a separate set of a benchmark which will reflect those choices. Similar to what we have seen in other parts, like ESG investing, there are asset owners who don't like holding tobacco stocks, they don't want to hold firearms, and other criteria which are there's a big trend towards low carbon investing, ex-fossil fuel, but that's an investment choice and investment constraint. It's not an investability issue. So what we have announced, if you've seen the press, is that for our mainstream benchmark, which we call investable benchmark, SNAP will be eligible. As it becomes, it will be eligible based upon investability criteria, not based upon whether it has voting rights or not. But there are a set of investors who don't like SNAP to be part of the benchmark. There is a separate set of indexes which will be launched that will not hold and these kind of dual class shares.
I think maybe I can comment on that a little bit. So usually, especially when it comes to issues like ESG and green issues and so on, we tend to find with our user community that yes, they want to keep those kind of factors in a separate set of indices in a different family, and that's what we do. Either we run custom variants of the standard indices like the Russell indices or the FTSE indices, or we create a new family of ESG-related indices. But in this particular case, what it seemed was coming back through the feedback when we ran our consultation was that this was a fundamental issue that they viewed in the context of investability as well. So maybe it's in a little contrast, obviously, to the findings from MSCI, but certainly when we look at the feedback that we got, when we talked to like the CII and some of their stakeholders, the issue seemed to be very fundamentally about investability. So that's the rationale for us taking that approach.
Good. Let me, since we're at the McDonough School of Business, I have to ask an international dimension question, or else I'd be run out of the building by Rena. So let me turn to China A shares. So China A shares are a class of shares of Chinese companies that are listed on either the Shanghai or the Shenzhen stock exchanges and quoted in renminbi. And up until earlier this year, were not included in various indexes. And Rahman and Waqas, both of your firms recently announced that you'll be including China Air shares in some of your benchmarks going forward. You talked about issues of investability, liquidity, some of these other things. So sort of two parts to this question. One, why were they not included previously? And then what changed? Why are you now including them?
So investability has another dimension which is called accessibility. So if you are not, if the country doesn't allow you to access a particular share class, you can't buy them. So basically they're not investable. So if you look at Chinese market, there's a alphabet soup of different share classes out there. Some of the share classes, some of them are listed in the US, like Alibaba is one of the companies, or Baidu. These companies, as a foreign investor, you can buy them. There are some share classes, like B shares, which are allowed, foreigners can buy without any kind of a quota or limits placed on them. Then there are share classes which are listed on the Hong Kong Stock Exchange. Now, there is a separate share class which is called A share class, which till 2002 was not even open to foreign investors. In 2002, they started a quota program where you can apply for a QFII, Qualified Foreign Institutional Investor quota program. Based upon that, you can buy those share classes. And over the years, a lot of progress has been made. They launched an RQFII program where you can use a renminbi to buy those share classes. Again, but you have to get a license to get it, and there was a repatriation limit. So there was a whole bunch of accessibility issues which was put in place. Then in 2014, they launched a program to connect the Hong Kong to Shanghai and then to Shenzhen in 2016. So these were basically a connect program where you as a foreign investor can buy those share classes, A share classes, through this Hong Kong Stock Connect program. But again, there's a daily liquidity and daily trade limit which are put in place for those share classes. Now, based upon the feedback, again, we did the consultation. Our consultation is a little bit different. We don't have an advisory board. We don't have a bunch of people sitting together in a room deciding. So we ran this global consultation, which ran for nearly, every year. We started from 2013 was the first time we proposed. And last year, pretty much there was a consensus in the market that yes, definitely you can go ahead, but do it in steps. The proposal was also linked to the amount of liquidities there to the Connect program. So what we announced and what we implemented over the summer was including only 5% of the market cap of the large cap stocks, which can be traded through the Stock Connect program. So that represented about 70 basis points of MSCI Emerging Market Index. It's a very tiny amount, but think in the context. Now, if suppose China A becomes fully integrated into a global benchmark like Emerging Market Index, the whole China will represent close to about 40% of the benchmark. And if you want to put in perspective, if you look at developed market benchmark like MSCI World, US is roughly about 50-55%. So in the Emerging Market Index, China will be as sizable as US is in the Developed Market Index. And in terms of market size, China is roughly the second largest. Japan is taken over in the summer because of tariffs and everything, but is the second largest stock exchange in the world. So these companies are coming in and getting integrated, and that's the same thing happening on the fixed income side. So from an investment perspective, if you're an emerging market investor, you cannot ignore China today. But there are still accessibility and issues which are there, which needs to be overcome before they can be fully part of the benchmarks.
I mean, a lot of what Raman says there is very helpful and very insightful and provides the context about how the markets have developed over time to the stage where investors globally are considering them to be part of their investable choice set. The way we do it is we classify countries according to on a scale of frontier, secondary emerging, advanced emerging, and developed markets. And we look at the local currency markets in each of the countries that are of a certain size, and we assign them one of those statuses, one of those classifications. The way that we do that classification assignment, again, is through engagement with the end users and the investors out there. We have a country classification committee. We have a pretty involved process where we look at a number of different factors or characteristics of the market in question. Can you convert FX? Are there onshore derivatives that you can use to hedge? Are there accessibility issues from the point of view of global investors, taxation, and so on? There's a pretty transparent set of parameters that we evaluate. And we evaluate that by looking at the markets themselves, ourselves, but also we talk to custodians. Can they get the money in and out? Are there settlement issues, and so on? And our country classification committee is basically, again, populated by experienced individuals who act in the markets on a day-to-day basis. With China A shares, it has become clear over time that the market has developed to a stage where global investors feel that they can invest. It's got the necessary liquidity. It's got all the characteristics for being able to invest and get the money in and out into funds and so on. Quotas have changed over time and have been relaxed. We do a lot of engagement with the local market regulators as well to assess, is the trajectory of developments in the market sustainable? Is it short-term, or is this going to be a long-lived perspective from the point of view of opening up? And we found that overwhelmingly the end users in the market were saying that the China A shares market is ready to be opened up and included in our emerging market indices, so it was awarded as a status of secondary emerging to enable it to classify that. As Raman said, the bond markets are also opening up. The Chinese bond market at the moment, the domestic government bond market, whether that's CGBs or policy banks or corporates, is set to be, it's currently the third largest bond market in the world. It potentially could overtake Japan and become the second largest, so it's really developing in size. It's a little bit behind in the equity market in terms of accessibility factors. We are currently looking at the accessibility criteria for the Chinese domestic markets at the moment, because we have a range of bond indices that are very widely followed, especially government bond indices. So that's something that's in train right now, and in lockstep with how the Chinese equity markets have opened up. It seems that the bond markets are doing so. But we'll go through a governance process to check through all of those different parameters in our country classification framework to make sure that that is reflected in the reality of the investors who are transacting on a daily basis. And if that's the case, then we'll make announcements about inclusion in the broader market indices on the bond side as well.
Great. So 3 letters that have come up multiple times, ESG. I think all of you have sort of mentioned this. For those of you not familiar, this is environmental, social, and governance factors. Just a sort of a broad, open-ended question for all the panelists here, and then we'll open it up for questions from the audience. So the index providers, you both sort of mentioned a lot of that. You don't have a dog in the fight on this one. It's sort of investor demand-driven. Is there anything you want to sort of add to that? Tom had mentioned sort of the difference between the role of the index manager and the ultimate, or the asset manager and the ultimate asset owner in this space. Is there anything you wanted to sort of add to that? And then Bill talked about some of the challenges now with some of the ESG investors. And can you get to some of, what do you think the long-term trend is? Is this just kind of a fad that's going to kind of run its course, or is this something that's here to stay? Is it sustainable, to use the phrase that the ESG folks use themselves? So just as an open-ended question for our panelists.
I think if you look at, again, from an ESG, Mike, you're pointing out that it's 3 different letters and have 3 different meanings. But more and more, what we have seen that there's an evolution of understanding of the topic itself. It's more of a sustainable investing. You can call it still a socially responsible investing if you want to think about it in that sense. Historically, it was more around screening of companies. And more people are taking a much more holistic view. They're saying that a company which is doing good for the environment is also probably better governed and has social policy. So the market should reward for that. In fact, we have done enough research on that, which shows that similar to a monetary policy transmission mechanics, the ESG is a factor on its own. It's basically get transmitted into the stock market, and the price of the company improves if they have better policies. So that's one of the bigger things. So if you are an investor, then definitely ESG is something. It's not a fad. It's not a Chinese hoax. It's basically something which every investor across the world is looking at. And we think that as investment process get evolved, the funds which are there today, especially on the passive side, will start to think about how to integrate that as a factor in the portfolio construction itself. So a lot of passive vehicles today, which are straightforward market cap, will start to integrate some of this holistic view of the ESG factor itself.
I think we see exactly the same trend. Is it sustainable? Well, it certainly seems to have grown in momentum. It's a long way since the days, 7 to 10 years ago, where it was really just about exclusion of certain types of companies, tobacco companies, and so on. Now it's much more of a holistic and integrated approach. Again, though, the role of the index provider in this space is to respond to the demand that's coming from the investors. So what they're asking for is a lot more data. We do a lot of work on data collection from all the public disclosures. It was interesting to see hear what Bill was saying about the size of the disclosures in each case, and that's a current theme, actually, that a lot of people are saying that on the disclosure side, they have to meet standards that one company is looking for in order to do their ratings and scorings, and different standards and different data collection that another company. So there's a current debate about, is there a way to harmonize across the different standards that have emerged, both between companies and also between different jurisdictions around the world. I think that's something that we support. Obviously, to make that a standardized process is something that would be, I think, beneficial, both for the issuers as well as for the end investors. The only cautionary note I'd put there is that in the phase of development of any type of product or any type of solution, you don't want to clamp down on innovation. I think we're at a fairly nascent stage still in the ESG models that are being developed. There's a lot of data collection that's going on, but the models to sort of assimilate that data into ratings that can be used to make indexes tractable, to make analytics tractable. I think there's still some innovation going on there. So we would like to see some form of harmonization, but in a way that doesn't clamp down on the innovation that is needed to continue to make the space mature.
Yeah, so Bill, how are companies, are they seeing just tons of requests for data, give me everything right now and we'll sort of figure it out, and then how are companies reacting to this? Do they want to see more of harmonization, standardization, or are they afraid that it's just going to lead to some standards that have nothing to do with shareholder value, those sorts of things?
Yeah, so I think ESG issues have been around for a while. I mean, there were shareholder proposals on those issues, 15 years ago, so this has been part of it. I think, it's funny, does the good ESG follow market performance, or do companies who are generally doing well are able to focus on that for what it's worth? You worry a little, there's whipsawing going on, there's no doubt. There's so many standards amongst cross shareholders. So this shareholder wants this, then this one has another. I mean, if you have a multi-shareholder base, it makes it very difficult. But standardization may not be perfect also. It may be focusing on one issue. So I think it'll work itself out a little bit. And I think it has to tie to shareholder value. And sometimes the debate goes so quickly. Now, being a takeover defense person, I used to like the classified and staggered boards because it gave the company some time to react. These are, for those who aren't familiar, in the US for a while, most companies had a provision where you get a third of the election every year. So a third one annual meeting, a third another one. Sort of like the US Senate. But shareholders wanted immediate accountability, and it was like, this all started back about 15 years ago, and it became the mantra of accountability. And the fact that Enron, WorldCom, Adelphia all had annually elected boards, and yet the accountability didn't happen, it didn't ring true. So those went out, and you'd argue now companies can replace the board very quickly, which is from an accountability perspective good, from a long-term planning maybe not so good. I think you tie some of these dialogues every once in a while to, well, how does this impact thinking? Because I will tell you, now that has gone, and now companies can act by written consent, shareholders, it's great from a shareholder accountability perspective, but it says, okay, if you have a slip in about a month or two, the board can change. Does that make for a structural long-term thing? And that's an honest debate, but you got to tie it to the fact that it is impacting corporate views. And I think when you start thinking about, because it will move to a harmonization, because it's hard for companies to follow, at least broadly, some general views on ESG. It's moving in that direction. I think the index funds understand it's got to be tied to value, and that should be good. But right now, it's in a lot of flux.
Flux, right. So, and Tom, so you manage money on behalf of millions of investors in thousands of companies, and there are dozens of sort of ESG sort of standards that are out there. How do you manage all this?
Right. Well, I mean, I just want to step back and say that, I think your question, is really the right one about, where is this trending toward? I mean, when you think about it, you can see a trend line, right? I mean, 15 or 20 years ago, the idea of like, a CEO and the chairman being the same person, I mean, that was almost like universally accepted. Now, it seems to be a view that, some divisions have that responsibility. You could pick a number of issues where you see a trend. I mean, ESG in terms of responsibility for stakeholders. I had the occasion for some reason a couple of weeks ago to be looking at a statement of General Johnson, the son of the founder of Johnson & Johnson, when they came out with their credo in 1943. And you could read it and you could say, my gosh, this could have been written last week in terms of, stakeholders, including employees, the community, supply chain, all of that. It's like, this stuff has been around for a long time. And I think that it is difficult, but when you look at particular issues, our approach is to say, this is about one big paradigm, which has to be constantly in focus. Long-term financial value of the shareholders. And I think that's where a lot of the misapprehensions can come in. Like, well, are you looking for like some values? Or something? This is long-term financial value of the shareholder. And I think you have to read our chairman, Larry Fink's letter in that context. You have to read, the work that we're doing with our 40, and I'm sure, to continue to grow stewardship team. I think the question around, how you manage it all is a good one. I mean, I think there are going to be some synergies both from technology and from harmonization. I mean, we see that even in areas like, in the securities field. I mean, and not just in the U.S., but I mean, as you say, because we're here, I should probably say something about international context. I mean, look around the world. There's efforts, whether it's the prospectus, rule that has come out of the CMU action plan in Europe, whether it's, some of ASEAN's work on, sort of a cross-border bond, offerings. I mean, the standardization is really necessary because only by that way you're going to get the synergies of a large market. I think some of that and some technology, can help. But clearly it's going to be, commitment. And maybe, an example of this, to go back to the dual share class just for a second, because I think it's an example of, looking at, I mean, that's a governance issue, right? It's like, and so I would just say, our BlackRock view on that has been, I would say, very much in agreement with what you were saying, Bill, is it's a complicated issue. Our view is, yes, in general, one share, one vote. That certainly is what we think in the long term is best for corporate governance, for proportionality, for shareholder accountability, and so forth. Are there cases where, you can say because of these particular facts it makes sense? I mean, UPS has a share of, a class of shares that it gives to employees that have a higher weight, and they believe that, okay, that serves certain important cultural, interests in terms of, mobilizing an accountable workforce. Should they be thrown out of, the index because of that? I mean, I think we would say let's look at that on a case-by-case basis. I think there should be some process, with a sunset, and then where a, full across-the-board shareholder vote is taken, with shares, one for one, voting on, yes, we want to continue that or not. So yes, there has to be some accountability around that. But it's clearly not a black and white, one-size-fits-all, answer. It's a complicated question. I would totally agree with Bill on that. So I guess, in sort of summing up, I would say that you can see a trend line. I think ESG is clearly important, not only as a product that people want, and which, of course, we offer, through our sustainability, oriented funds. And of course, ultimately, it's for clients to decide what they want. But it's also a paradigm through which we look at all investing, because it goes to whether or not, management, in our view, is at least appreciating the long-term forces that are affecting their business.
I was going to pick up on that because you had a whole issue. It's the perfect one. You had a whole issue. Management's taking care of themselves, so now all of a sudden the boards became much more of a focus. Then shareholder democracy. Now it's well, then the shareholders, well, they're kind of intermediaries for other people, and so on and so on. So it's like you keep shifting. The bottom line is you can make a general set of rules, ESG, corporate governance rules. As a business person, it's like who's looking in the eyes of the management team, and whatever the rules are, and you meet with them. That's what shareholders, when PE folks are in charge of the company, you look at them and you say, and they hold themselves accountable, and they put themselves out, and then the next year you come back and say, this is what you did. And is the lead director or chairman someone who has a counter, I mean, you can call them whatever they are, but someone who's got a firm voice that can be a counterweight, well, that makes sense. The biggest change in corporate governance, in my view, is when they went to majority being independent. So you have a lot more, independent voices now out there. That's important. And then I think finally, who the comp committee, are they going to negotiate comp? The rules are great, but the shareholders, if they're going to be, because the directors are supposed to be overseeing the company. They got duties. They get sued if they don't live up to those duties. The shareholders have limited information. Not all of it is out there. The thing that I would be very focused on is, of course, the rules are important, but being able to, through the stewardship group or whatever, to go meet with these managers and directors and look them in the eye every once in a while and say, okay, I get the rules, but what are you doing? I think that's, in my mind, generally, you got to have the person who can judge the person that is doing the judging. But that's as important as any rule. And that's harder to do now. Companies have become so widely diffuse in shareholders. If you had like 5 shareholders owning 10% each, we have such diffuse shareholder bases, it's harder to do that. So not a smooth final on that, but it is what we're dealing with day to day in the markets.
Yeah, so I actually have some, I could ask some follow-up questions, but let's open it up for folks in the audience. We have a diverse set of folks here that want to ask some questions. And I would ask if for folks that have not asked questions yet, we'll give preference to them, and in particular, if we have students that want to ask questions, I want to make sure that we give preference for them too. And okay, yeah, so far, ma'am, I think you've asked several questions, so can we let somebody else behind you ask some questions? Thank you.
Excuse me. Thank you, really good panel. I have a question on ESG. There's an incredible amount of confusion in the area as to what ESG, everyone seems to have their own view of ESG. There was a recent article that suggested a distinction between risk-return ESG, which is another form of investing, another investment strategy, and would be subject to any type of analysis, any other strategy, and collateral benefit ESG, where the objective is to achieve some good economic, moral, ethical objective. Your thoughts about that? Tom, you seem to suggest that you were close to that, but I wasn't clear about your thinking of dividing the world into those two categories as a way of bringing some clarity to this whole field of ESG.
Thank you. I'm not familiar with the particular article, you read, but I would say that, in terms of the way we approach ESG, again, we're a fiduciary. We have no business, taking non-economic, values and having them essentially, supersede the long-term financial interests of our clients or the asset owners. So it really comes down to, if I think I understood it correctly, the first of the two sort of paradigms that you were talking about, that it is, are we comfortable that the board of the company is looking at all of the trends affecting their business? Is a company that doesn't have any policies around, say, board diversity, when, there is evidence that, companies with more diversity on their board have a more complete way of analyzing and looking at things and coming to, as an example. Is it better for a company to have, a clear view of their stakeholders that they're involved with, including their communities, including their, workforce, and have a long-term plan to how to maximize that relationship and to avoid the pitfalls that come, when you're not treating them well, okay? None of this is like to prejudge a particular outcome on any one of those factors, but it's to be satisfied that there is a process in place at the company, at the board level, that there is engagement on them, they're taking it seriously, and that they're engaging with you, which is why, some people say, oh, well, you voted with management so many times, you must not be, really doing ESG right, to which I would say, no, we're engaging, we're having a constructive, conversation. I mean, if they don't come back and listen to you, year after year, then you can look at our record where, as I said, we're very transparent about what our record is, and when we vote against management on things, then obviously there's a limit to the patience on that. But I think it's really all about engagement. But to answer your question, I hope I'm doing it as well as I can, is to say that, the paradigm behind all of that is long-term financial interest of the asset owners who are our clients.
So if I can add to what Tom said, one way to think about if ESG is a factor is to think whether it's a common factor. So think about, we know value, quality, momentum. These are common factors which drive the performance of the stock market, net of stock specific. So question becomes, is ESG a factor? Then means it can be extracted on its own, and it can be used as a way of generating alpha. In some cases, we have seen that happening, but it is not pervasive across the globe. So today, ESG is considered as more of a risk factor. So if you can neutralize the risk coming from certain set of exposure to ESG, you can generate a little bit of premium. But generally, we have seen that in certain markets, like emerging market, ESG tilted portfolios do better than the non-tilted portfolios. So definitely, ESG is a common factor in emerging markets. So that is how you should probably think it. Probably that's what the article is referring to, whether it's a risk factor or it's an alpha factor.
I would add just one very quick thing. I think the point that Bill made earlier on is very well made. This is still in flux. And your question is about, are there different categories within those factors that are all lumped together under the banner of ESG that might separate out economic versus values? I think it's hard to draw a very clear line because certain investors have certain different views about what drives the risk-return performance versus, what should be categorized as sort of values-driven and what should be categorized as economic risk-return performance outcomes-driven. That will play out over time. But definitely the trend that Ram was talking about earlier on is that these things are increasingly being looked at by the investment community as things that should be incorporated in the construction of passive investment vehicles. We've seen that with the dual share class issue, which is the G issue, bleed into, away from our separate ESG indices and maybe be bleeding into the standard market cap weight indices because they're very clear that that's something that is about investability. And that may happen with others over time. But right now, I think it's in flux and it needs a lot more development.
Question over here.
Yes. Thank you very much. I think I know the answer to this, but all of these various emerging concerns, requirements, compliance, et cetera, there's some sentiment that this is tending to, companies are tending to now draw away from going to the public markets for funding and going back to withdrawing from the markets, going to private funding, et cetera. I think the market's so large, and when you need funds, you go where you can get it. But do you have any sense of that, where it's sort of it's just too hard situation? Thank you.
Yeah, I mean, this was related to the discussion that Chair McLean was talking about, sort of and I think Bill brought it up, or somebody brought it up, that we have half as many public companies now as we did before, and just, the cost of going public, the benefits of staying private. Any sort of thoughts on that in terms of the governance issue? Is there just too much is it just too costly for companies to be public nowadays with all these things? Or
Look, what the problem is you say, when you hear the anecdotes in Silicon Valley about people not wanting to go public because the markets are so short-term, and then everyone's like, oh, that's not true, or the regulatory, that's not true, it's other reasons. Well, the urban myth is that, and you're hearing it, and I don't know if it's as much the regulatory burden of the reforms from 15 years ago, but there's a view that the markets are going to make your business very short-term focused. If you're growing a company, so when you go, which is tough because you really want robust capital markets, that's a good thing. And so when people say, why do you want to go public? I guess it's to monetize your equity, right? But it used to be also to issue additional equity to grow, to buy other companies, things like that. Well, we haven't done too many stock deals, and secondary transactions are few and far between. So we need to re-energize the case for going public. And frankly, I think the index funds help there because of the long-term perspective. And I think the business owners who want to take their companies public need to hear that more often, because they're hearing the horror stories of getting, management teams getting beaten up and not wanting to invest because, they got to return capital or what have you. So again, I don't know if there's a quantifiable aspect of this, but it's certainly something that we're hearing anecdotally.
Good. All right, so I think our time is up, so I want to please join me in thanking our great panelists. Thank you. Thank you.